Hello, good afternoon. My name is Mihkel Torim, welcoming all of you to LHV Group's financial plan and forecast introduction for the period of 2026 to 2030. With me, I also have Meelis Paakspuu, the Group CFO. So we will be covering topics ranging from market view, macro forecast, and then going more detailed into our strategy and financial plan as well. So starting off with the business environment. Estonia, which is our core market, after 3 years of negative or very slightly positive growth, we are expecting that the economy will start to pick up gradually. So there's been a more like expectation building up that this year will be different. So we are expecting 2.2% GDP growth this year, and then a bit higher or similar growth rates throughout our own forecast period. We're expecting consumption to revive. We're expecting inflation pressures to ease quite a bit. And then also there's a slight positive impact from some of the tax changes that have been made. Also, we are expecting some activity pick up in the manufacturing side, mainly supported by the recovery of the external market, our export partners. Nevertheless, the recovery is also heavily reliant on public finances. So the state budget deficit is going to be very high this year, expected at 4.5%, which is quite a bit related also to the infrastructure slash defense spending in this year. So, and obviously in the backdrop we have consistent uncertainties regarding geopolitical risks, which can then whether it's related to trade issues, any other economic shocks in the region. This is, again, I think we're sort of used to this situation already. So overall, hoping for the best and presuming that we have built up a pretty good foundation for more structural growth within the Estonian economy for the next few years. As mentioned briefly before, so we are anticipating that the inflation rate will start to come down in Estonia. It has been quite high rates in the past several years already, which has definitely impacted consumer demand, consumer sentiment as well. So we're expecting it to drop to 3.2% in 26, and then our plan also presumes that it will stay at 2.5% going forward, or at those levels. Labor market somewhat improving as well, expecting the unemployment rate to gradually go down, and also wage growth to stabilize at 4.5% levels after quite a significant hike in the previous years. Again, very much of it also linked to inflation, which is understandable. Looking at our second biggest market, UK. So on the economic growth, we expect that the GDP will move at around 1.5%. It was for the last year, and then going forward, pretty much averaging on the similar levels. It has been driven by the services sector and also a good contribution from the real estate and retail, which is positive for us since most of our activities related to real estate and trade related loan activity. So we expect slight acceleration inflation to stabilize as well. And the Bank of England's base rate we expect to be at 3.6% by the end of the year 2026, and unemployment to stabilize at its current levels at around 5% for the next, let's say, year and a half. So some words about our plans. Just to summarize the year that we just closed. Yes, it was a challenging year. We did not fulfill our financial plan. So our net income was 2.5% lower than we originally anticipated, and the net profit also 6.5% compared to what was planned pretty much a year ago. Having said that, LHV Bank in Estonia, so we grew the loans and deposits by 11%, which is, I would say, a very good growth rate given the macro backdrop as well. And in the UK, we have been able to grow our loan portfolio by more than 2 times. So we have reached 782 million euros by the year end. And also our retail offering has reached significantly more customers than it was, let's say, a quarter ago. So by the end of the year, we have reached 5,000 customers directly, and it was mostly gained throughout the last months of the year, as we have pinpointed more exactly what is it that we're offering on our deposit product side as well. And then we, as a group, we also have the asset management, and they have done very good job in terms of second and third pillar pension funds. So it was the market-beating performance that they achieved in 2025, which also having said that, they also delivered a very strong net profit contribution to the group, while in nominal terms it's low, but the actual change was quite significant. And insurance, which is also a subsidiary in Estonia, performed very well and grew 13% with their premiums versus a 2% overall market decline. So overall, as a group, our return on equity was 16%, and the cost income was 52.3. But yes, I mean it has many aspects as we're looking at 2 different banks and then our smaller subsidiaries. So the composition is quite different in terms of these ratios. So taking a step back, we have grown quite significantly over the course of past 5 years, despite the fact that the macro environment has been also challenging. So it's been roughly 20% for loans and 9% for deposits, and also our assets under management has increased somewhat. And our loan portfolio has been mainly driven by the Estonian corporate banking and also home loans. So, and this, as mentioned, I mean, the share of LHV Bank in UK, share from group portfolio has increased. So we are looking at it now as it's already contributing 40% of our overall portfolio as of the end of 2025. So on one hand, looking at the profit growth before during 21 to 25, as you can see, we have had a few years at around 60 million, and then also with the increase of interest rates, the profit shot up quite a bit. So achieved 140 and 150 in the years before, and now with the changing rate environment, and given the fact that still we are our significant contribution to our income is from net interest margin, net interest income. So due to that, the profit has indeed declined, which is pretty customary to the sector. Nevertheless, going forward, and also taking into account the contribution from the UK bank as well, which has been growing its critical mass, its operating leverage as well. So we expect that with the combination of somewhat better rate environment, growth in the Estonian economy, growth in the lending activity as well in Estonia, especially in 2027 and from there on. We believe that the expected profit growth will still be quite significant, but it's already based on the foundation that has been built during the past years. So obviously the work will continue, and there's significant these are significant achievements that we expect, but this is the baseline that we are expecting going forward. So some comments about the way that we look at the group strategy as a whole. So if we consider the main growth pillars, the most important part is the business that we already have, both in Estonia and UK, and making sure that it's well focused, it's predictable, that we have a good understanding on obviously on where we're headed. We have good understandings of the risks of the products that we're offering. Looking a bit further ahead, both in Estonia and in UK in parallel. In Estonia, obviously, for a quite long time. In UK, just for a short period of time, we have been developing our retail offering, and a lot of focus this year will be also on upgrading our retail offering in Estonia, and also developing it in a way that it can be more easily scalable in terms of number of customers it serves, and obviously by scalability we mean that we can manage the products, we can manage all the processes in a way that once we add more customers, it's the cost will be pretty much the same as it's the sort of a standard for any modern banks or neobank offers. And then taking that into account, we are also looking a bit more broadly in terms of figuring out if and when we should consider using that retail offer to enter any other European markets. But this is, again, we are really thinking about small steps, small incremental changes, also trying to learn from the UK bank in terms of how they have developed the offering, and then sort of using that on our own technological platform. So there won't be anything definitely happening this year, but this is the ambition that we'd like to consider moving forward. But again, it's first steps. It's really sort of setting this as a target per se, and once we have a clearer view on what exactly and when, then we will be making announcements accordingly. But this is more a preparation stage for doing this and laying the foundation. And talking about foundation as a group, so one critical component is governance. The governance structure. We're also making changes or adding members to our group board. So we have a new board member to the group incoming in spring this year, subject to approval of the AGM. Christian Schröder, who is also has been a managing member in Pictet Group, has a very good and broad knowledge of the European banking sector in general, also very good in-depth knowledge about the regulatory environment. So this will definitely add additional dynamics to how we manage and see our plans. Then we have work to do also on the risk management side, just making it more broader in terms of group level risk management, harmonizing some of the processes along the UK bank and the bank here we have in Estonia. And then also that relates to data and regulatory reporting as well. So we have quite recently established a separate division with the data and AI experts just to rebuild and refurbish our data platform, because we think it's essential for any proper AI applications as well to be modern in that regard. And that also, as mentioned, links back to all sorts of reporting, business intelligence, and as like a feeder for management decisions as well. And then technology and the product development as well. So we are obviously trying to up our game and make sure that we have all the necessary tools and skills in order to do what I have just mentioned that we want to do. So the goal of this is quite simple. So we want to make sure that we can execute our financial forecast with confidence, especially going forward, taking into consideration the technological changes and opportunities really that it gives to us as well. And yes, also that's a very important input to make sure that we have a good and clear vision also going forward. So it's not just about the end of 2030, but it's really more about the trajectory idea of how we want to position ourselves going forward. And yes, this pretty much just summarizes what I've just discussed, so we'll not stop here any further. And then I would like to give over to Meelis, who will then talk in detail about the actual financial and operational plan for the next years.
Hello from my side as well. That's I have always mentioned that financial plan is nothing else than just putting our activities into the numbers. That's so it is about the business plan, and high level Mihkel already covered this. So theoretically it is possible already to calculate our outcome. But looking at 2026, it is going to be another tough year for LHV. That we are focusing on business growth, on volumes and customer activities. We are expecting that our incomes are growing faster than the cost base. And when we're looking at the loan portfolios, then it is going to grow more or less around 11%. And at the same time, deposits by 5%. These numbers show that we have thought through that what is going to happen in Estonia and in UK, and then we see that the deposit base in Estonia is not growing very fast in Estonia. Plus, we also want to repay deposit platforms, so we lowered the lending growth in Estonia as well. That instead of having on group level 20% year-on-year growth, we are more or less having half of that. That's coming to the number side, actual profit is remaining more or less the same, but operating profit is growing by 11%. That's largest deviation is coming from loan loss provisions but in 2025 were very, very, very low. And in 2026, as it is forecast, and we are always making this line forecast very, very conservative, that we have predicted that there will be 15 million euros of credit provisions made. Same time, when I look at the return on equity, it is still around this 15% level that when in 2016 with 2025 it was 16%. But starting from 2027, it is already picking up to close to 20% level. Cost income is slightly improving. That's looking at 2026 to 2030. As you see, we plan to increase our profit from current 117 million to 290. If we are looking backwards at during the higher interest rates, we made in 150 million euros of profit. So we want to double it anyway. That now we just we are in somehow cycle what is against us. That so we seems that the growth is even faster, but actually we are more or less going in the same direction that we used to. It's about both growth in Estonia and in UK. UK is going to be growing faster even in long run. That UK portfolio is going to be bigger than. It's not going to be bigger than Estonian one, but it is from the current 14% share inside the group. It is going to grow to 25 to 30% level. That's so quite a bit more growth in UK compared to Estonia. That our deposits are planned to grow 50% within this next 5 years. Loans more or less double. And when I look at assets under management, then almost 50% as well, or actually more than 50% from 1.7 billion to 3 billion. And our cost income, but is one of the key items that we are looking is coming down from current higher levels to this what we would like to have through the cycle, but it's then below 40% level. And return on equity from current lower years going back to 20% and beyond that in 2027 to 2030. That's so things are getting better, but it is requiring quite a bit of work as well. Looking at the bank and other larger subsidiaries as well, that regarding 2026, the focus is about digital channels and customer experience. We want that the customers would have an easy way to open accounts, to become a customers, and also to have a very, very good digital channels that they would be able to themselves do all the transactions what they would like to do. Same time, we acknowledge that our investment service offering is decent, but for in our own eyes, it is not good enough. So we would like to enhance this side. So we are putting effort into this. And in 2025, we spent sizable amount of time into modernizing our infrastructure and also moving them to cloud. That's then we plan to finalize this within Q1, and maybe one or two smaller systems will remain in Q2, but effectively all the LHV systems are very soon in clouds, but makes it also quite a bit more scalable, easier to develop, and this allows us to start quicker development processes. And we are able to bring new services to the customers much quicker than we used to. And another items what are very standard for the bank is that automatization. There is always some manual work, even in the very well working companies, that there is always something still not automated. So this is where we want to spend our time. That there are still many processes what include some kind of manual activity, but also limits the growth in of this kind of transactions that you just add to send people. And as well, data is a key component in today's banking set, not only the reporting and governance, but also that access and data lakes and how easy it is to do ad hoc queries reports and how easy it is to predict what customer base is going to do. That's partially it is very standardized processes, but partially it is an AI-based this kind of vague analysis but giving hints what could happen. So data is very much in focus. And number terms in Estonian banking entity, the growth is modest from lending side. Same time, when we look at deposit side, here it is actually even showing a negative number, but it is not presenting this fact that we actually would like to repay all the platform deposits. So to replace these ones, also to shift inside the bank from corporate deposits to retail deposits, there is quite a bit of challenge. But overall net profit more or less remains the same. But again, when we look at provision line, we add 13 million of provisions in the paper that hopefully it will not appear, but this is a number here that without that the numbers would be much better. And return on equity, as there is a higher capital base as well on the on bank level, that then return on equity is lower for 1 year, but after that it is going to be going back to 20+% area. In UK banking entity, that's the target is to increase in every segment. That's a focus area in the retail side is about developing from one side app and the customer experience, and from another side to add services. That most critical component is a multi-currency account. That at the current moment UK entity is able to offer only activities in pound. We would like to start offering other major currencies as well, as we are used to have it in Estonia. That's if this is there, then we can start offering also FX transactions and start offering to many customers much wider scale of the transactions. In SME lending, UK market is different compared to the Baltic or Estonian one. That's the normal time period from application to loan contract payout in general is a couple of months. That's we would like to reduce this time period several times. That's in Baltics, in Estonia, we are talking about days and weeks from application to payouts. But in UK, the standard is different, and we see that there is quite a bit of possibilities to change this approach by offering quicker decisions and more standard approach to the customers as well. And third focus area is banking services. Again, starting from multi-currency accounts. This brings in possibilities to offer FX and also multi-currency payments. And another focus area is launching of credit products. That many of banking service customers need some kind of liquidity help in for some very short time periods. So it makes sense to start offering these ones. Number terms, growth is significant. That deposits by 37%, loans by even by 54%. Still looking at comparing with the last year. Last year our growth was in a lending side 104%. That it is in percentage wise it is coming down. In absolute terms more or less same. Profit more or less doubles. and mainly it is coming from the SME lending side. And target is also actually the key component is own customers. Currently, we have 5,000 customers delivering not payments, but deposits. We would like to reach 40,000 customers in UK. That's moving on to asset management sides. Asset management is about providing very decent investment yields to our pension investors. That's so it is everything is about that, and then the second focus is about sales. That's so sales is a critical. We believe that sales has to be through digital channels and telemarketing and cross-selling throughout the group. It's not about having desks in shopping centers. That's these times our we would like to see that the customers have all the information in hand. They are able to make proper decisions by themselves or in our digital channels that where we are able to convince them by showing proper yields. And looking at last larger subsidiary of LHV Insurance, here it is a growth story together with an Estonian banking entity, cross-selling, and mostly maybe the only item that needs to be said separately is that we are terminating the reinsurance coverage for traffic insurance. So we have been growing to the levels that we are able to accept higher costs as well. And this helps on the profitability side as well. But otherwise, we assume that market remains more or less similar as today. We would like to grow, but the growth is coming together with the bank. So that's it from the number side, and now we are ready for the Q&A.
Thank you, Mihkel and Meelis, for the presentation. As mentioned, let's now jump into the Q&A section. So starting from bottom up, first question. In 2026 to 2030, LHV Group expects to grow loans from 5.5 billion to 10.1 billion. Would it be reasonable to assume that most of that growth is expected to come from LHV Bank in the UK rather than homeland?
Yes, the expectation is right that UK proportion inside the group is growing. That still Estonia is going to be much higher than the UK entity, but UK the growth is coming from there.
Why do you forecast such modest expectations for loan portfolio growth in LHV Bank in Estonia this year? Looks subpar by your own historical standards. Also looks counterintuitive against the improved macro backdrop and expected boom in investments. Any structural shift, competitive pressure, or else?
The main topic is about liabilities. It's not point to grow based on the very costly liabilities. It is about this that we would like to repay platform deposits in Estonia. We would like to fund ourselves from retail deposits. We do not want to grow fast when the liability side is not properly there. So in the liability side in Estonia, we would like to have only two funding sources. It is effectively retail deposit base and for mortgages also covered bonds. We do not want to use other type of funding, and if we are using, then it is temporary.
LHV Bank in Estonia had a market share of circa 14% in Estonia last year, or just slightly up versus 2024. Do you have some kind of market share target set akin to what some of smaller banks have? For example, Coop Pank aims to grow its market share from circa 6% to last year to 10% by 2030.
Yeah, I mean, Meelis can correct me. I mean, our intention is still to grow above the market, but we do not. Basically, I think we're done with tracking the market share as a target or having the largest market share per se. It's really more about growing above the market, but that's pretty much the baseline.
We have never had a market share as a target, and so I hope that we will never will have in future that. Yes, we have stated for some years that we would like to be the largest bank in Estonia. This target worked very well. But nowadays we are not using this wording anymore. That because the value current size to the largest one, it doesn't add qualitative jump for the entity. It is adds complexity, but not much of the value. So we plan to grow. Yes, we plan to grow faster than the market, but we are not setting ourselves quantitative market share based data because it's about doing an really good business, not just any business.
What is behind the projected operational expenses growth of 7% in LHV Bank in Estonia for 2026? Is it wage pressure rather than the need for higher headcount?
We have had a structural change in our employees that we have more engineers, IT people in the staff. That quite a bit of this change has happened within 2025. So if we are now going into 2026, then that will be the full year effect. When in 2025 it was an maybe half a year effect. This is a driving factor that there is a certain pressure towards employee costs. Same time, this helps to automate things. This helps to develop our products faster, and by doing that, it helps to gain efficiency.
Yeah, I also wanted to add that this is the impact that we expect, that once our employee structure shifts a bit more towards engineering, data and IT as well. If we are projecting growth and also projecting long-term growth with a relatively stable cost base going forward, this means that we have to do quite a lot of processes differently as well. And also, I mean, I think we're also mindful or we see the technological impact to the market, to how banks operate going forward. So it's really, we can consider it as an investment as well, but that obviously means that we have to also execute these investments well. So that's the summary.
What is your long-term targeted return on equity for LHV Bank in the UK, and how do you expect to achieve it?
In long run, we want to have a return on equity of 20%. Same time, it is an expensive environment and very much competitive environment in UK. Still, SME sector, we could say that in our terms, it is not so well covered by larger banks. So there is room for LHV type of entity. But then when we look at the number terms, then if the loan portfolio is below 500 million pounds, then it is loss-making business. If it is higher than 500 million pounds, then it is already generating some profits. But reaching 20% return on equity as a business line, you need more or less an 1 billion pounds loan portfolio. And beyond that, you're starting to add to the and help with other business lines. So we need to grow at least to minimally to 1 billion, better to 1.5 billion pounds, and after that, the return on equity should be in place.
Please comment on the expected increase in provisions in 2026. It cannot be explained just by normalized level if we compare expected provisions to loan growth in years behind 2026.
It's not about loan growth as such. It is about taking conservative view on the loan portfolio. That's in LHV we have been using 0.3, 0.4% of risk costs from the loan portfolio as such. That's so we are in the normal times. That so we are using this as this ratio in the forecast. That we yes, luckily we do not know is there losses coming as of today. That's so we hope that it is not realizing, but in the forward-looking forecasting, we are always conservative on that side.
Could you explain the backdrop of projected operational expenses growth compared to the previous financial plan? You were previously anticipating 3% operational expenses growth over the strategic period, but have now doubled it to 6% on group level.
Mainly the question, there are two angles on that. One is that we have increased the growth rates in UK side. By increasing the growth rates, it automatically increases the cost as well. From another angle, that when we were looking at the Estonian side, that and when we were last year and put together the plans regarding moving items to the clouds, we didn't know all the cost factors there. That so actually moving things to the clouds is slightly more expensive than we expected. And the third item was that we tried to automate. Our plan was that we are automating faster our processes. Last year we spent more time on moving a system to the clouds and then we were able to spend on the automations. This year we have more time to deal with automation as well.
Does the reference regarding exiting or repricing low return on equity corporate loans in Estonia imply that you will be more selective with new issuances and aim to grow below the market, but with higher risk profile?
The higher risk profile is not the case. That's we have been always selective. We have been always able to sell loans with a higher margins, but the risk profile is still very much in line with other banks. That's it's about corporate lending is not just about price. It is about communication. It is about understanding the customer. It is about structuring the loan. That's so we see that there is a room, but we are not giving loans to absolutely everybody. We are very much selective.
Given your strong capital position and plans for selective market expansion, would you consider acquiring other challenger banks in the Baltic states, such as Citadele or Nordea Bank?
I mean, I think consolidation in Baltics, I would bet that some will happen in the future anyhow. So we are open to two ideas for sure. But having said that, no, I mean, we don't have anything that we can discuss now. But overall, I mean, if if I'm looking at the LHV Bank in Estonia, then obviously there is always benefits to scale. So yeah, we're open-minded, but as said, there's really nothing that we are considering. I think as Meelis mentioned, we are pretty much set to do some of those changes that were discussed before, growing both the bank in Estonia in a good way, making sure that in the long run we can achieve the efficiency goals that we're really after. But yeah, I mean, scale is always a benefit if you execute it in a good way.
And yes, we have investment banking in our name, so that whatever is on the market, you can be absolutely sure that we are looking into it. It doesn't mean that there is a transaction behind, but we are looking into it.
Please describe your typical UK customer and explain why they choose to bank with you in what appears to be highly saturated market.
Yeah, I can start. I mean, we have real estate lending and SME lending. So on the real estate, we're pretty much focused on various product developments, refurbishing. We are not looking into highly saturated markets as London, which are quite specific, but we're looking at regions outside and mainly smaller projects. And in the backdrop, we have a very strong team on the SME lending side and on the real estate side who has been doing this business for quite a bit of time. So it's more like a niche market, which our team is executing very well. If there's anything to add.
Maybe on the retail side as well, that there is hundreds of banks in UK. That's but just handful of them are actually very large. The rest of these banks are pretty decent. They are, let's say, in relatively small size and not known generally. That this allows us to also an possibility that we are just among them, that we are able to attract the normal regular customers. That's it's about pricing, it's about communication, it's about marketing. That's your product offering has to be at least par.
Yeah, maybe a comment on that side as well. When the retail offer was started, it was I think in May this year. So in the beginning, there was a very limited traction, but then the team reiterated, really tried to figure out what's the marketing angle. So once there was a broader campaign relaunch in late autumn with very clear positioning on the offer itself, not on the bank, there was immediate shift in interest. So it's as said, I mean, nobody's really expecting LHV to really enter any market. It's really up to us to figure out how we can tackle the client groups, how we can build the product offering, and we're just trying to do it in a good and sort of cost-conscious manner. So obviously there are always risks involved, but yeah, so we are trying to find our spot.
I understand that the projections for this year are done with extreme conservatism to avoid what happened last year. But realistically, from which line items do you see perhaps the biggest upside potential for these projections, whether it's on the income side, costs, provisions, or loans, etc.?
If you're asking where is a potential upside, let's say, if we would be very sure that it is there, then it would be included in the forecast as well. That's it is about funding. It is about getting the proper cheap funding in a decent size. If we are able to raise that one, then it means that we are reviewing also some of our plans regarding asset sides. So yes, there might be that we are ending up with a higher loan portfolio. That's the preconditions have to be fulfilled.
Very well. Profitability at LHV Group level is lower than that of LHV Bank in Estonia. What is driving this lower profitability, and how do you expect it to develop in the future?
It's simple mathematics at the current moment that LHV Bank in Estonia is driving, let's say, let's take this to 2025 and 2026 out. In general, we have been always about 20% on return on equity. But group is not consisting of only Estonian banking entity. That's there is always something else as well. That's when we look at asset management, and asset management is doing close to 20 in normal years, and some years when investments are better than are achieving it. Insurance company, it's the first year when they have 2025 was the first year when they clearly outperformed our internal targets, because before that it was still in the startup phase. That now they are performing well. And in UK side, the banking entity has only 2 full years. That it's not yet ready. That there will be another couple of years till UK entity will start delivering 20% return on equity. But when we look at the size-wise, the UK entity is already 14% from the total loan portfolio. So this is the largest entity what is not able to deliver 20% of return on equity as of now.
Your plan assumes net interest income in 2027 to grow much faster than loans in 2027. What is the reason?
We have been always using market view on the base rates, and market view on base rates is it's a 6 months Euribor is and also ECB rates are increasing by 20 to 25 basis points.
Now it's a bit into the future question, but your plan assumes fee growth acceleration in 2029 versus 2028. What is the reason?
2029 versus 2028. That's it's about volumes. It is about pricing of some products, but mostly it is about volumes.
All right, thank you. Currently, there are not any new questions added to the Q&A section, so I believe we can end the investor call now. Thank you, Mihkel and Meelis, for the presentation. Thank you for the participants joining the call.
Thank you.
And hope to see you in the future.
Yeah. Have a nice day.
Have a nice day.
Thank you very much. Have a good day.